You don't like that? If you haven't owned the biggest and best tech stocks, I wrote that.
I don't agree, so I'll fight you on that.
So I'll say if you haven't owned the best, I'll remove biggest.
No, leave it, and then we can argue about it.
Oh, okay.
Unless you just want to already admit defeat. Hey everybody, JC Peretz here, founder of allstarcharts.com, and I am joined as always by my man Steve Straza. This is Pardon the Price Action. Let's get right into it. Tech has been all the rage this year, Straza. If you haven't owned the biggest and best tech stocks, you're underperforming. With the indexes retreating from old highs, is this trade now over?
No way, right? Thanks for the layup. These stocks have been the best, up over 50%. From their lows last year. Let them breathe, right? Let them work here. So if you look at tech, yes, we have, basically achieved new all-time highs, and now we're peeling back a little bit. I think this is just, it's an opportunity for rotation into some. Yep. So if you look at semiconductors, it's the same thing. If you look at some of these bases, maybe software, you're seeing something similar. We're running an overhead supply. And the most important, the largest names, your Microsofts, your Apples, same story. I think these stocks have, earned a breather.
I think this is an interesting ratio chart of technology, finally getting back to those March 2000 highs relative to the Russell 3000. I think that's really interesting. Yeah. I was laughing at the question with you earlier because it's like, oh, if you haven't owned the biggest and the best tech stocks, but the truth of the matter is it just hasn't been the biggest and the best. It's been really growth rotation. I would take biggest out of that equation and argue it's just the best. You're seeing it going down the cap scale. You're seeing it across industry groups within technology. So while these mega caps like Apple and Microsoft, certainly back to those former highs, you're seeing the same thing in the XLK, seeing the same thing in semiconductors. But a lot of them that got beat up more, had more downside, have seen actually more upside and still have a ways to go before they get to those all-time highs. Growth in general, not just tech, to be fair.
It's a great point, right? And it's not that I think the trade is over for tech stocks. Maybe the biggest tech stocks do take a breather because you got Nvidia, Tesla, Meta up 100 to 200% this year. I would look down the cap scale, right? Look for that expansion and participation. Look for smaller tech stocks to start giving you better opportunities than the biggest ones. Let's go. So laggards are at support. While the leaders run into resistance, we were just talking about it, right? The laggards continue to hold support. What are you seeing from some of the weakest groups?
In bull markets, you tend to see groups holding support and buyers stepping in. In bear markets, those support levels tend to break. These groups go down and make new lows. You look at small caps finding support last month. There was a trade we put on that's working out well. Micro caps kind of within that same group, support coming in. Financials continue to hang in there. They have not rolled over. Crude oil still hanging in there. Energy still hanging in there. Coal, another one that we've been pointing to, still hanging in there. And then the really beat up ones, look at online retail holding in there. China hanging in there. And, today, looking at Walt Disney, is this where you pinch your nose and just buy it, right? Is this where that happens? Buyers have stepped up here before.
I think so. And this is becoming a big theme for us, right? We're talking a lot over the past few weeks about buying stock charts we might not normally buy, like Disney. Why? It's an environment thing, right? You can bank on that catch-up trade more in an environment where everything else is working so well. And when I just take a step back and think about these first two topics that we just discussed, right? We have leaders hitting resistance, hitting old highs, logical levels for some corrective action, some consolidation, a little give back. And then we look at the laggards holding support, right? Rebounding off of these key levels. I think it just speaks to maybe a really sideways range bound second half of the year. And I think investors should be prepared for that.
An interesting take. I don't disagree. All right. This morning, you made me give you my favorite vehicle to play a potential new bull market run in crypto. Do you agree? I said miners. Do you agree with that?
Yeah, I do. I really do. I would direct you. Listen, this is a good slide. We've had so many bullish developments. I think June has been a major win for the crypto space. A huge win, right? We have institutions now finally adopting and moving into the space. I think that bodes well for higher prices in the future. move to the bubble chart now. It's the miners. It's all about the miners. I think an important point that goes overlooked a lot, right? We talk about Coinbase as a crypto stock or Square or a lot of these other names. The crypto miners are not crypto miners, JC. They are Bitcoin miners. And when you think about how thin the participation is within the world of cryptocurrencies, it's Bitcoin and Ethereum, they're working, and pretty much nothing else is. You see that in the bottom left-hand corner of the bubble chart with all these altcoins, right? The Bitcoin miners are literally in the business of mining Bitcoin. They do well when Bitcoin is achieving higher prices. I think that's the move. That's the high beta. That's the leveraged play right now. I couldn't agree more.
Yeah, I mean that's what I'm in. I guess I own Bitcoin also, but we're in the marathon, the Mara. It's working. But you take a look at this: Solana, Polygon, Avalanche, Dogecoin. Really all continue to struggle, and it's really these miners that are really stepping up big time. So we talked about the catch-up trade, as technology, which we just mentioned, and the Nasdaq overall, running into those former resistance levels. Do we get that appreciation that catch-up in Bitcoin? I think that's what we're seeing now.
Yeah, totally.
For sure. Interesting. All right.
Maybe the Nasdaq catches down a little bit. That's fine too.
Yep.
So JC's energy trade. Listen, you told me you're buying Chevron this morning. Let's talk about it.
So, for me, getting back to this rotation that we're seeing, right? We talked about it at Disney, at Support. Do we get that rotation? We saw it. We've been seeing it in financials. We certainly saw it in small caps for sure, seeing it in industrials most definitely. So the question now becomes, do you see it in energy? Here we are at Support from former resistance. Unleaded gasoline futures are doing the exact same thing. Heating oil futures doing the same thing. So it's not just crude oil. And look at energy. This is the energy sector ETF, which a lot of Chevron, a lot of Exxon in this one. We talked about Occidental Petroleum. I won't steal your thunder. I'll let you get into that one. But for me, I'm seeing Chevron really hanging in there in a similar way as Disney, as small caps last month, as Caterpillar last month, where it was like, do you hold your nose? Just buy it right here at 150. This is what it looks like overall. I've been kind of in the neutral camp while we've been below that 184, 185 level, right? Because that was the next Fibonacci extension level. The market has acknowledged these levels and respected them. So I do as well. When you look short term, that 150 looks good. If Chevron's above 150, I like it long. I got in yesterday. Here we are a couple of points above 150. I got in yesterday at the close. If we're above 150, I like Chevron long.
Listen, I don't hate it. I totally get it, right? In a bull market environment, you bet on the laggards playing catch up. That's the trade here. I would just say
trade. It's a trade in this environment that I think makes sense. You like Oxy better though?
Listen, it's well defined. It's clearly defined. You know it. You know when you're wrong, and you're out with a small loss. This is the same trade in Oxy, right? I guess the only difference is I got Warren Buffett at my back. So I would say Oxy 60.
Warren Buffett owns Chevron too, Bubba.
He loves them both. They are two of his top 5 holdings, actually. Yeah. Both. You're absolutely right.
So I have also Warren Buffett at my back.
He hasn't been a buyer over the past few years, like he's been a buyer in Oxy. So yes, you do have Warren Buffett at your back, but we have the Buffett zone in Oxy. He keeps coming in at the same level. So I feel like an extra degree of comfort buying in the 57, 50, 60 range. But listen, energy is a cute trade right now. It's not a bad trade, but I think it's a cute trade.
All right. Well, I'm, sometimes I like to get a little cute. You guys said the same thing about my Caterpillar and small cap trade last month, right? So this is kind of like in that same, I'm pressing my bets.
You keep being rewarded.
Especially with well-defined risk, by the way.
Listen, you've been rewarded for being cute. Be cuter. Go for it.
All right. Well, we're getting all bulled up on. We've been getting all bulled up on industrials lately, as I just mentioned. Still on Caterpillar. These stocks continue to pop up on our scans. What about building materials?
Dude, they're popping up on our scans. Now they're popping up on our friends' scans. I saw Patrick over with the Buzz at the chart report also had Vulcan Materials in his report this weekend. We had Vulcan Materials and Martin Marietta in our report for Under the Hood yesterday. Look at these two indexes, right? This is Dow Jones Building Materials. They're built very differently. And then S&P 500 construction materials. It's basically like the home builder theme. These are the companies that support the home builders, right? They sell the inputs. Let's look down. Beacon Roofing is a name we've been talking about for a long time now. It's a hot corner name. Some very bullish insider activity in this name. over the past few years. These are the bases we want to be buying. You can look at this one right now. It's trading around 80. It's building a little high and tight flag. This is the weekly. But if you drill into the daily, buy a flag breakout from 80 to 100, I think that's a really nice trade in the leader.
I think it's interesting. This one coming from the Vulcan Materials. This one coming from the Under the Hood report. This is an interesting one for sure. So this is VMC, Vulcan Materials, making new highs today as we speak. Let me just see the market cap quickly on VMC. So this is a basic materials company still, based out of Birmingham, Alabama, sitting right around 30 billion in market capitalization. So not too small. This thing's come a long way from those lows last summer. So market bottom is very similar, and I think gets back to how are stocks acting when they get back to those former highs from late 21, early 22, because we've seen in Apple and Microsoft, like we just pointed out, but there's a ton of stocks that are sort of doing that. How are they reacting? Here's another example. NVIDIA ripped right through those highs. Palo Alto ripped right through those highs. We've seen some others. Add Vulcan Materials to the list of stocks that are now exceeding those former highs. The more and more we see of that, what does that lead you to believe that the others are going to do? And what does that mean for the overall market?
It's not just tech, and we're going to talk about that in the 2-minute drill. But guys, right. Building materials, so many good opportunities there right now.
For sure. All right.
So this is a game that we like to play. It's called Word Association. I'm going to give you a word or a phrase. You're going to tell me the first thought that comes to mind. Real estate.
Well, the first thought that comes to mind, real estate. I'm looking for a beach house in over in the Jersey Shore down in Avalon. It's expensive down there, boy, but it's lovely. So when I think about real estate, I think about the American nightmare. I guess the National Realtors Association convinced everybody that you should buy a home, and nice marketing for yourselves, people there. But the American dream is more the American nightmare in a lot of ways. It's just a money suck. But I've come to terms that it's not an investment. It's a luxury. You can put in a pool. You can change whatever you want. Like you own a house. Like do what you want. Within reason of your HOAs and whatnot. So I look at it kind of just like a money suck pain in the neck. I hate to be such a negative Nance, but I am. But we can hedge ourselves by owning the home construction stocks. Which continue to act well. These are some of the strongest stocks in the market. Consumer discretionary in general, when you look at the casinos, you look at the cruise lines, airlines, I understand, are not consumer discretionary. They're in industrials, but they're not consumer discretionary, right? So you're just seeing a lot of strength coming out of the consumer and residential real estate, home construction stocks is just part of that story. The whole consumer's dead. The consumer can't afford anything is nonsense. The data suggests literally the exact opposite of that narrative. So when I think real estate, I think consumer discretionary. I think my own headaches with the guys with my basement. It's a pain in the neck. I still don't have the doors I want. Like it's just never ending. But home construction stocks on fire.
Yeah, listen, I'm about to get new windows here. These guys make good money. I'll just say that. They make good money. Listen, when it comes to the markets, right, and price action, how we can use price action to kind of delve into or gain insight on what's going on in the real estate market right now, you have really two main sources. You have home builders, home construction, what you see here, making new highs, and then you have REITs, right, which is really commercial real estate. Home builders, think residential, consumer-facing real estate, REITs, and the actual real estate sector itself, because you just mentioned, JC, the home builders do not belong to the real estate sector. They belong to discretionary. But you're seeing two opposite things, right? So the residential real estate market is on fire. It looks great. That's why we're talking about building material stocks. But the commercial real estate market, which you can really get a read on using REITs or XLRE or IYR, the real estate sectors, not doing so well. But both are up.
Best performer on Monday, though.
Both are up over 3% this week. You're seeing a really strong bid in REITs this week. And again, that goes into that Laggards at Support kind of theme, right? Where they're really rebounding off of these old lows. So it's all constructive. See what I did there?
Hey, this guy. Come on now. This guy. All right.
Usually you kick off the 2-minute drill. Listen, we talked a lot about overhead supply. Topic one, using technology, but it's not just technology, right? It's really the best stocks. So let's discuss overhead supply in a little bit more detail here and look at some more charts.
Well, industrials back up to those former highs on an equally weighted basis, small caps across the board. This to me looks like a massive base.
Yeah.
The more times the level is tested, the higher the likelihood that it's going to break. That's how I learned it. Look at the DAX back up to these former highs. Technology, Apple and Microsoft, we already discussed, back up to those former highs. The XL, which is basically half of the XLK, just those two stocks. So you're seeing it in the index itself. France is back at those levels, right? Germany's at those levels. UK's at those levels. The leaders are at overhead supply, and the point that you made earlier that we could be sort of like in a sideways, messy back half of the year on a cap-weighted basis at the index level with rotation into the laggards and some digestion of gains out of the leaders, creating sort of a sideways, messy market. I mean, that makes a lot of sense to me with the risk of the leaders continuing also.
The best stocks shown here, whether it's tech here in the US or just some sort of leaders. Yeah, here you go with the CAC. This is luxury goods overseas. This is LVMH, right? This is not tech stocks driving the strength.
Well, you got a lot of industrials too, 23% industrials in France.
And same thing with the German DAX, right? So my point is it's not growth stocks at all. Point being, the best stocks back at all-time highs. Do we get through? I think some have a better chance than others, right? If you think about where they came from, something like industrials, I think they're up like 25% off the lows from last year. Tech is like 50%. Maybe they have a better chance to blow through and resolve from this base first.
Germany, largest sector exposure in Germany is industrials, over 18%, FYI.
Yeah, totally. So the point remains, it's not all tech stocks. When you look overseas, it's just the best stocks from whatever region. The best stocks are running into these overhead supply levels. I think it's just important to monitor the reactions here, right? Some will probably break through. Like you mentioned, NVIDIA, we have plenty of tech stocks that already burst right through. Do the industrial indexes break right through? Does tech get it done? I don't know, but I think these key levels we can use as kind of like a signpost for the future to define a risk, to see what groups we kind of want to overweight and what groups we don't want to overweight going into the third quarter.
Interesting that we're talking about industrials as the as a leading group. I don't necessarily think that's a bad thing for the stock market. All right, Straz, hot takes. What do you got this week?
I also don't think it's something that many people are talking about. Like industrials aren't viewed as a leader right now, right? So it's interesting.
They are.
Them back at all-time highs. My hot take is that the stock market was up yesterday. It's something that we talk about a lot on here, like that theme of cap weight versus equal weight, right? We saw it play out in real time yesterday, where just because the biggest and best stocks were experiencing some, significant profit taking on a one-day basis, right? So not a big deal. The indexes were down. Dow was down. NASDAQ was down. S&P 500 was down. If you look at the S&P 500 sectors on an equal weight basis, every single one was up yesterday except for healthcare. So it was a great day for the market. We're seeing that broadening participation. The leaders, these big mega cap tech stocks, giving back a little. It's literally investors taking their money from the winners, profit taking, and then moving that money into other stocks, broadening out that participation. Very constructive, very bullish in my mind.
Yeah, I don't necessarily have a hot take, maybe just reiterating kind of what we're seeing in terms of looking underneath, under the hood, putting in the work. A lot of people fell into the trap of the lazy. Oh, if you back out these seven stocks, the S&P is flat for the year. Like that statistics like that are completely insignificant and meaningless. Like at any point, you can sort of cherry pick points in times where, the biggest companies are dragging or pushing the markets in any one direction. It's an interesting narrative if you're in the business of, like selling ads, like, you're the Cartoon Network where you just need to get people sort of, give them fun facts to think about. Like, what are those called? Like brain challenges, like those brain twisters or whatever, like that don't make any sense and don't help anybody. If you're in that business, then stats like that are good for you. But if you're in if your objective as an investor is to profit and make money, then those sort of silly mind games are a waste of your time. It's poison. So I really, I've always, I shouldn't say I've always thought that. I've thought this for a long time. And with every cycle that passes, it reiterates, take the time to count how many stocks are going up and how many are going down. You don't need your computer to tell you that. And statistics can be manipulated in ways to make you think that something is good or bad. Forget all that. Just put in the work. Go one by one. Put on some music. There's 30 stocks in the Dow Jones Industrial Average. It's not that many. There's only 500 in the S&P 500. It's not going to take you that long. Go through it. Or find somebody who does and read their notes, right? But it's really, really important. I can't emphasize enough. It's a market of stocks. It's not a stock market. How annoyed are you that I keep saying this over and over again, Straza? Or are you still like, he's right?
It's a good lesson. And I would say just be prepared for that moment where, be mindful of what the mainstream media is doing, what their goals and objectives are. They're very different from yours as an investor or a trader, right? So get ready for an environment where for the last 2 quarters, we heard only 5 stocks are propping up the market. Well, for the next 2, you might hear the market's down every day, right? But they're not going to tell you what's going on beneath the surface, which is what I talked about, like the tape from yesterday, where the biggest stocks might drag on the indexes now, right? But beneath the surface, we have some really positive developments. The headline that you will see is the S&P 500 is down 0.5 percentage point. You're not going to see participation is broadening beneath the surface, right? So we're playing a different game, and it's just important to keep that in mind.
Yeah, for sure. Great point. All right, thanks for watching, guys. It's been Pardon the Price action. Make sure to give us a like and hit the subscribe button so you never miss an update. And follow me at All-Star Charts on Twitter. And be sure to follow Steve at @Straza. Leave a comment below and let us know what you think. And we'll see you next week.
Peace.
Adios.